Hello everyone, my name is Oliver from Lux Trading, and today I'm gonna be talking to you about trading during holidays. Is it wise or not? As many of you may have noticed, the conditions in the market change during some months. But why does that happen? This is because public holidays have various effects on the financial markets, including the forex, indices, and other markets. For example, in institutional forex trading, where banks, hedge funds, and large institutions physically buy large sums of currencies, which have to be delivered into bank accounts, in some situations, public holidays may require that these settlement dates are postponed for one business day. But in the world of retail currency trading, where traders trade contracts for difference, this of course does not apply. We know that the forex markets are open 24/7, 365 days a year for retail traders. But the liquidity is not always the same. Bank holidays are the days where in the country that the bank resides, there is a public holiday. And therefore, the banks are less likely to be actually involved in the forex market on the days when they're closed. And because banks are the single biggest participants in the forex market, if they are on a holiday, then most of the volume is gone. When volume is reduced, this can have the effect of making currency pairs static in that market. But this thinning of liquidity can also cause voids and gaps, which can have the effect of creating spikes in the price action. As an example, when the Japanese have a public holiday, it's not unusual to see the US dollar Japanese yen pair have some extra volatility. While on the other hand, when the Euro area and the US share a public holiday, such as Christmas, you would typically find thin volatility, especially when those two currencies are paired. Another thing to consider, which most retail traders do not, is that there can often be extra volatility in the 24 to 48 hour period before a holiday, and also a day or so after the holiday. This is known as the public holiday effect, and it is well known particularly in the stock market, where investors see extra volatility and usually extra buying running up to the holidays. Sometimes this is not quite so evident in the forex market. However, things to be considered are large institutions are not going to be in the markets in the days previous to the holidays or during the holidays themselves. They also don't like large exposed positions during the weekends or holidays. Often you will find that banks, institutions, and traders like to adjust positions by either closing them or switching to another asset, for example, out of a currency and into more stable asset like gold before the public holidays. Certainly, the longer the holiday is, the more of the thinning markets you'll see, with Christmas being the best example. This type of situation can lead to extra volatility, and you should bear this in mind, especially if you intend to place trades before, after, or during public holidays. Overall, forex trading during public holidays is a bad practice. During this time, most professional traders take a break themselves as they are unwilling to trade against low liquidity and high volatility. The banks will be out of the market, there will be lack of market moving news, and during the session the market will be volatile and you can experience spikes and get stopped out. So overall, I would not recommend that you trade especially during Christmas and major holidays. But if you're gonna be opening positions during the holidays anyways, there are a couple of things you should consider. Number one, low liquidity. During the holiday, there will be low liquidity in the markets, as the market giants like hedge funds, international banks, and market leaders will not be present to take the opposite side of your trade. The big giants will have very little interest buying or selling currencies during the holidays. They know their business well, so they will not take any risk during that time. Therefore, they will spend their time on a beach with a cigar and a glass of martini rather than watching the charts. Number two, high volatility. In the forex market, we know that there is an impulsive, non-volatile trend and a corrective volatile trend. The impulsive non-volatile trend represents the participation of market giants. During impulse, traders can earn money easily as the market follows the levels better than all other times. However, the absence of market movers will keep the trend volatile, so there is a chance of false break and stop loss hunts. The evidence of high volatility may push the price nowhere after eating your profits by creating false breaks. As I told you earlier, top forex players and market movers will be out of the game at that time. That means that no one can produce a big interest in a currency pair. As a result, we'll most often see a ranging market. Therefore, there is a very little possibility to make some decent profit. Number three, and I think the most important, is unpredictable market conditions. Forex market is a decentralized market where no one can know where the price is gonna go in a certain time period. All the traders and investors in the forex market earn from predicting the market-based probabilities. If the probabilities work well, trader enjoys the profit. On the other hand, if the probabilities go the wrong way, the trader suffers a a loss. Now the question is, when do probabilities work well in a forex market? The answer is in the normal market, when the big giants are in. However, forex trading during holidays is risky, as it is hard to predict a market as there is no stable trend. There is a possibility that a strong bearish setup from a strong resistance may go wrong. Moreover, due to low liquidity, the whole day may move in 15 pips, or it can move drastically in a minute. It is hard for ordinary traders to react to that market condition. Moreover, if you trade with expert advisors, you should avoid those tools during the holiday periods. All automated tools are based on some technical indicators. On the Christmas holiday, the indicator might completely mislead your algorithm, and your otherwise reliable system may suffer a huge loss. And last but not least, number 4, take a break yourself. Doing overtime may harm your health as well as your brain. Moreover, the market conditions will be putting extra pressure on you as you're seeing your stop losses being hit and spikes that you couldn't have predicted. In that case, it'll be wise to spend some time with your family, take a breath, and when the holiday is over, start trading again. These breaks are a great opportunity for traders, as the forex market is in some sense a mind game. Taking some training in emotion control and stress management may enrich your trading psychology. Moreover, you can plan what you're gonna do in the upcoming half year, quarter, or a year. So at the end of the day, the best practice during the holidays is to actually take a break and spend some time with your family. Let the pressure of the markets dissipate for a moment and slow down. You should definitely visit your relatives on the 25th of December instead of following the Euro USD chart. So don't worry about the markets in the holidays, take a break as everybody else, then come back stronger after you've taken a break. And that is it from me for today. If you have any more questions, please leave them down in the comment section. And if you want to learn more about Lux, feel free to reach out to us on our 24/7 live chat or send us an email at info@luxtradingfirm.com. My name has been Oliver, and I wish you all a successful day trading. Have a great one.